Africa initiative. Somet, thank you for making time.
Thank you.
Let me begin with you, Somet. When we say responsible banking, what comes to your mind?
Responsible banking, well, I'm not in the banking industry, I'm more in the technology space. But what I look at responsible banking is, organizations as banks delivering service to their customers in a way that builds trust with those customers. Because we all know if you don't build trust, then your customers stop using your service. So I'd say, building capabilities and delivering service and experiences to your customers that actually builds trust.
Sam, you've been in the banking space for quite some time. Last time we spoke, you said you have over 20 years in the banking space. What would you say are the building tenets towards responsible banking, or rather the principles of responsible banking?
What I can say, when you look at what a bank does, basically a bank is an intermediary between those who have savings and those who want to borrow. And therefore, a bank takes responsibility to both parties. And so and the relationship between one who puts money in the bank and the bank itself is that of debtor creditor. That means the customer lends the money to the bank. And in lending the money to the bank, they are not taking any collateral. And so they expect a high level of trust. They expect a high level of stability. They expect that the bank will be able to keep its promises. If money is put on a current account and a customer wants to draw the money to make a payment, they must find the money available, and the bank must facilitate that to happen. And so that is how then the relationship grows. Over time, as people come to expect certain things from banks, in the sense that the quality of service, the diversity of offerings that they give to customers. If I want to keep my money there for 1 year, they cannot keep the money on the same terms like somebody who wants to keep the money for 1 month. Both of us will be treated differently. So that relationship then develops over time, and you find that if it's a good relationship, then people always want to take money to the bank. If it's not working, people begin to withdraw and fear the bank and start taking monies to the mattress. And that doesn't become beneficial to the economy. So because if we look at how much money is in the banking sector and how much money is actually under people's mattresses, it could be a tale of a low level of confidence that does exist between the customer and the bank.
Dr. I know you're in the education space, but I'd like to find out from you, do you think from everything Mr. Mkoko has said, Kenyans are getting that kind of relationship and that kind of responsible banking from their banks?
That's a difficult one. You're putting me on the spot. But anyhow, I'll try and respond to it in a more macro way. And what I mean is, as an academic, I want to look at it from the relationship between the bank, the customer, and the economy at large. And maybe to just expand a bit, what's a responsible banking could be, is you're looking at sustainability in a bigger way. So issues of climate change come in, issues of circular economies come in, issues of development goals come in. And so when you look at that, then you can say, on one hand, yes, Kenyans are getting it, or the customer is getting it, because even in these Think Business Awards, if you look at the categories we have put in, banks have really tried to say, okay, I'm funding agribusiness, I'm innovating around agribusiness, I'm innovating around sustainability. And therefore you can say, okay, yes, we are getting there. But then there is the other hand. Of course, starting 2016 to now, banking has not been the normal place. So if I start from interest rate caps and then now COVID-19 and very many things that have happened in the Kenyan economy, the banker is torn between, do I lower my rates? Do I heighten my rates? And what is responsible banking to a Kenyan? Maybe they're thinking, I want the lowest rate, but probably that's not the case. We want an open rate, not the lowest rate. So it is a yes and no, and I think we're trying.
So Matt, I'll come to you briefly, but Sam, picking up from where Dr. has left it, it's a tricky balance, but on one hand, the bank has to remain in operation, but on the other hand, they have an obligation towards the customer. Where's the middle ground?
It's always been a tricky thing to balance between the services the banks would give to depositors and what they would give to borrowers. And so the link is to be able to say, if I am going to extend credit to customers who want to borrow to invest or run their businesses, I also must be able to pay the person who is giving me the deposit. So you'd find that there's always, you have to strike that balance. And so in essence, you're looking at creating an efficient system that is able to serve both parties and have a positive contribution to the entire economy. And that's then what brings the challenge. And sometimes we have seen situations where some banks have actually gone the wrong way, where because of the manner in which they manage their credit risks, in which they invest customers' funds, they find themselves in trouble. And you find a situation whereby a bank has closed and is closed with people's money. That usually brings in a shake in the confidence of the banking system, and it is something that should never be encouraged to happen, because, as we said, if people do not develop sufficient trust in the system, then we'll find that many of them will not engage with banking institutions.
So, Matt, I'd like to find out from you, how can people develop trust in the banks, and what should banks do in order to ensure that their customers can trust them?
I think you can look at it both sides, both from the banks itself and definitely the consumers. So from the bank side is looking at, how do you rethink or reinvent how you deliver services to your customers. And at this point in time, I think technology plays a very critical role in that. So being able to rethink and use and leverage on technology of this day to deliver the best service that you can to your customers, but also at the same time being able to cut down on costs and risks, and sort of that is the benefit towards the bank. Now for the end consumers is also being able to gain knowledge and skills around how does technology, how does your environment today affect the services that you get from banks. So you see now that a lot of banking and interactions between your consumers and the banks are now moving online. You now have a plethora of people out there who are taking advantage. I always say never underestimate human ingenuity. So it is upon also for us as consumers to also look at, and this could be an avenue for banks to also educate their consumers around what threats are possibly out there, and what are the practices that consumers can put in place to make sure that as they operate and they transact with their money across different systems, that they are actually able to keep themselves safe.
Dr. I'd like to come to you. Only recently are we seeing banks begin to seriously uptake technology and start taking things like cybersecurity very seriously. Why are we seeing a sluggish pace in adopting the most essential of technologies that could streamline the efficiency of services that they're offering to Kenyans?
Thank you for that question. I think if you look at it from a 2020 perspective, then probably that question has now run very fast, such that now everyone is actually taking up technology. In terms of how to afford now innovative offering to can I say, common mwananchi, now that we're in the Kenyan space, you realize that most of the technology is based on very maybe heavy data intensive and the like. So I think there is still space for innovation in the data space before you can be able to now massively reach the low ends of the economy. And I think Sumet could be well placed to respond to the question of innovation in the data space, so that you can reach those people who are currently predominantly USSD based and not data intensive. But I think, like you rightly put it, only recently banks have taken on this fintech and all these solutions quite aggressively. And I think the integration between fintech players and then commercial banking will play a very big role going forward.
So, Matt, quickly.
So definitely there's a lot of innovation both in private, public sector, banking, and the different solution providers, startups who are creating innovative solutions. So I think the opportunity for the larger banks of today to partner with these startups to create really interesting solutions is quite interesting.
And speaking of interesting solutions, Metropol Corporation Limited has been at the forefront. Recently we launched 2 products. Maybe some you could get into it and just why we saw the need, or why rather Metropol Corporation saw the need to come up with such innovative products for the market.
Well, I'll cut through the question because there's a lot involved in that. Metropol basically is licensed as a credit reference bureau, and as a credit reference bureau, what we provide is a mechanism through which banks share information on their customers, and therefore that helps to build customer profiles, and the same profiles are then used by banks to assess the customer credit worthiness. Information asymmetry has been a challenge in this market for a long time, and it contributed to part of the high interest rates that we saw banks charging customers, because if a bank is not able to evaluate a customer's risk profile, then either they are going to ask for collateral or they will be trying to charge a higher interest, in which case to try and compensate for what they do not know. When that mechanism started, obviously what we have seen in the market is that there has been more uptake of credit, more customers are taking credit, and also there has been an increasing element of fraud. So that you find, because lending is now going digital, banks are no longer having to meet their customer on face-to-face. All the transactions are happening in the digital space. See, if I take your ID and I apply a telephone line on that and apply for credit and use your profile, that transaction will go through. But at the end of the day, the identity of the person behind that particular transaction may not be the actual person. And so credit information sharing, digitization of banking transaction, which is supported by emerging technology, is also emerging with other challenges that pose additional risks to what the banks are facing. As the credit risk goes down, operational risk begin to go up. So you find that the bank has got to find a balance through which, and it can only then be supported by other players who are facilitating identification, and also being able to provide additional alternative information to measure credit customer risk.
Good point you've raised there, and I want to bring in Sme because you're in the technology space. How can you come in and complement banks in this space?
So in the world that I work in within Microsoft and working with different startups and partners, I think there are technologies that definitely give the opportunity to look at how do we help banks reduce that risk of fraud by taking a proactive approach. Now, we have banks hold a lot of data points about their customers. How do we leverage on that to create experiences where banks can able to proactively look at those risks and create engines that will allow them to reduce that risk so as to deliver services more efficiently? So definitely technology does play a key role, but I think also better enough is looking at how do banks create really interesting partnerships with those solution providers, the startups, the companies that build these technologies. So that way you have an ecosystem of players that have solutions that actually cater for all these challenges that the bank has.
Most of the time when you talk to people in the IT space, they say banks do not have budgets for cybersecurity.
Well, I don't work in a bank, so I wouldn't know if they have budgets.
You work in the cybersecurity space. How many banks have come to you with the budgets?
So I think sometimes I think we go too overboard in cybersecurity, and people get very scared about it. But it starts as simple as people understanding their behaviors, how they transact. So I know people go crazy. Oh, we need to implement this massive system that costs millions of dollars. But if you actually look at it, it starts by just changing a few things within the banks, and that will massively improve how you deliver services, but also reduce that risk.
Dr. I want to find out from you, what's in need for banks if they adopt responsible banking principles? Where's the light at the end of the tunnel for them? Because they're in a business.
Great. I will go back to the very old adage of every business operates within an environment. That environment, the ecosystem, the customers have given a license to operate, such that if it is removed, that license, then you don't have anywhere to operate. It's unfortunate we're in circumstances of COVID-19, but I'll use that. So maybe you want to sell or you want to do business within the COVID-19 environment, and there is no one to sell to, so go out there and sell. Let's see. And it's the same thing. When you adopt responsible banking, you're creating a circular economy. So all the way from bottom of the pyramid, the resources are going around. So you come from, say, agribusiness, you come from climate change, you come from sustainability, then it comes back into the banking system, because the banks are the intermediaries that are actually channeling all this economic activity. And the most important thing is banks will then, for once, be out of this accusation that they are not linked to the real economy. And I think that's a big winner for banks.
Sam, there's this thing that's called textbook economics, and somebody might accuse Daktari of that. From a banker's perspective, how practical is that?
Well, I think if there's one industry that really doesn't practice textbook economics, it's the banking industry. Yes, there are guidelines provided by the regulator, also macroeconomic drivers that banks are supposed to observe. But if you look at the actual practical banking as it happens here, then you start asking a lot of questions. How do they, for example, fix their interest rates? How, for example, how do they select their customers? How do they develop products? You would find that if you look at the profitability of the banking industry in Kenya vis-a-vis the customers that they're supposed to support, there's such a disparity that you wonder, how does it happen that if you are in a business relationship, one party prospers much better than the other party? So there are all questions, that all manner of questions, and when we go back to the textbooks, what we read in the textbook is not what we see on the ground.
Yeah. And
so there must be another way in which actual banking practice is actually carried out. And there have been a lot of attacks on the banks, both by Parliament, when the interest rate capping happened. What was driving that? The issue was that the banking industry continued to be more profitable while their very customers are becoming poorer. So there must be a way in which this can be controlled. But to go to what one would expect is that there must be instruments in the economy that can be used to navigate things. Yeah. What I keep saying is that there's a fundamental flaw in the structure of the financial system in this country, in which you find that you have a strong banking industry and a weak capital market. And when banks, for example, are looking at creating long-term liabilities, mortgages, what sort of funding do they give to this? They're using short-term funds to create long-term assets. Why don't they match those long-term assets with long-term liabilities, bonds issued on the capital market? That would see a moderation of the interest rate. Because if you are taking short-term funds, somebody who is on short-term funds is likely to come for the money faster. You go to the maturity transformation between taking deposits on short-term and lending on long-term is quite a challenge. And so you find that in the whole of that, a lot of things come up that are not clearly understood. The other thing that we keep asking, for example, the mortgage industry, in terms of creating more mortgages, why don't we have securitization of mortgages so that people who have invested or institutions that create mortgages can be able to sell those mortgages to investors through a securitization process and be able to create more mortgages, because housing is one of the factors that is a challenge in this market.
But just on that mortgage point, I think one of the reasons why Kenya has about 26,000 mortgages in a population of 47 million is because the mortgages are exorbitant, the prices. And like you said, I'm giving you a huge amount of money, but I'm giving you a very short time to repay it back.
Yes, there's clearly a mismatch in the funding structure. Two is that the origination, the suppliers of the mortgage themselves, the supply of mortgages has been skewed to a certain category of the market. So you find only the kind of houses you find being put up do not fit what you call the guy who really needs those houses, because the lower cadre of society. Nobody's building houses for those people. If you go to estates like Madare, whatever, you find people who are putting up structures that are very dangerous and which cannot be funded on mortgage purposes. So mortgages have targeted a certain market, which is a very small market, And that's why you'll find that mismatch in terms of supply and demand of what is available.
Dr. When the interest rate cap was introduced, it was supposed to ensure that Kenyans can breathe a sigh of relief when they go to their banks to borrow. However, what happened is we saw banks held on to their money and opted to invest the money elsewhere, government bonds, the real estate sector, instead of lending because the risk was high. And many Kenyans, as we know it, SMEs do not have collateral. Then the rate cap was removed, but everybody is very scared to introduce new rates because they don't want to be termed greedy. So where does that leave that interest rate conversation?
Very tough questions. Let me look at it at the time of the cap and probably speak on the side of banks a bit. So I am in business, I am a lender. On one hand, I'm faced with credit risk, which is paying me a rate of 13%.
A month?
Per year.
Okay.
On the other hand, I'm faced with, call it risk-free, government security that is paying me 12.75%. What will you take? Will I take credit risk evaluation that pays me effectively 0.25%, or will I take the risk-free of 12.75%? It makes all sense for me to put my money on this other side that is not exposed to risk. But of course, that then changed the role of banks from the intermediation role to then the investment role, which of course was a misnomer in the economy. Who is to accuse? Is it the bank? Is it central bank? Is it government? I leave that question open, so maybe someone else can. Yeah, so that was a very interesting mix of things that we couldn't easily come out of. Where does this leave the conversation even after lifting? Who will run ahead first? Who will not run ahead first? I think the conversation is still very big. I remember in one of the Kenya Bankers Conference, there was this question of why does Kenya enjoy very big spreads of 8%, 7%, when banks in Malaysia only get 4%, 3%, they still survive.
China, it's way cheaper to borrow. But even in Africa, Senegal, Cote d'Ivoire, 5%, 6% interest rates.
Good, but the bankers have an answer to that, and they'll tell you, you put your bank or any retail banking branch somewhere, even Kenyatta Avenue now, leave alone even outside town. How many security guards will you put? How many doors will you put? All those cyber security is all here. So the cost of doing business is very high. Therefore, you must cover that spread. So we have a challenge, like Sam said, on the real economy side that we really need to deal with, which then will make banks real intermediaries. And so the conversation to me is not bank versus the customer, but it's a bank within the environment within which it operates.
And you've mentioned that you're a lender. I want to presume you're a digital lender?
Okay, whichever lender.
Okay, you've already preempted my question. But during the Afro-Asia FinTech Festival, and even the Central Bank of Kenya governor was there, he said that because of the cash crunch in the market, digital lenders were able to come up very first, and they were the easiest solution. But the rates they were charging per month were almost triple or tenfold what the banks were charging on a yearly basis. So on that front also, if you're in that space, how do we ensure that you stay in business but you're responsible to the borrower?
In fact, maybe 10 times is an understatement, because 360% vis-a-vis 13%, that is
a lot of money.
Yeah, so much. However, I've come to learn one thing. The Kenyan borrower, especially the low-end borrower, is not purchasing rates. So the price question probably doesn't really ring in their mind so much. What they are looking for is efficiency and access. Now, if you can give me access at the easiest way, so we started off with this whole issue of security, so you ask me for an ID, then you want me to bring my wife, you want me to bring my children, definitely you will lend to me. But if all you want from me is an ID number, and in the evening I have my money, or within the next 10 minutes I have my money, then that's what Kenyans are going for.
What is credit, what does the CRD say with regards to digital lending and the default rate, Sam?
First, I need to add my voice to what Dr. has just said in terms of the cost structure that does exist. There is the element of the cost structure, which is Kenya is perceived to be a high cost operating environment. But also, there's also the perception of risk. There's the perception that risk in this market is extremely high. If you look at NPL rates, they're above 10%. And so when you factor that plus the reason for high costs, then you begin to see the argument that a lender or a bank would be using to try and fix what their interest rates should be, and also the profit margins that they expect to get in this high risk environment. So other than cost, there's also the perception of risk in this market. But the introduction of Credit Reference Bureau actually was supposed to tackle the issue of that perception of risk, because it arises out of information asymmetry. Now that you have all the information you require about a borrower, can you therefore try to match the price that you're charging to the risk of the customer?
Good.
That hasn't happened. We need to see a situation whereby customers are being charged a price that reflects their risk profile. Yes, it is in the laws, but the implementation of all this becomes quite a challenge. And banks will always find a way in which they charge the interest that they think would compensate them for the risk that they are taking. We know there has been an attempt to provide an APR in this market, an annual percentage rate, which takes into account the total cost of credit. Publishing that has been a challenge. So what we are told are actually quotations of nominal rates, but not the actual rate that customers do pay. Again, the level of the transparency that we talked about comes into question. How transparent are banks when quoting prices to their customers? Yeah.
So, Matt, please add your voice here.
No, definitely, I think you're right. Yes, the transparency is quite interesting, but also I think a lot of institutions today in this country, we collect a lot of information around our customers. If I go to a bank today and open an account, I fill in this very long form. I go next year and want a loan, I fill another long form. So one, there is a lot of data that banking institutions have. They also have access to technologies that can do quite a lot of things, but I don't think they're necessarily fully implemented or taken advantage of. And so that creates a situation where we're still, working in the days of the typewriter. We're still implementing the same practices of back in the day, but we say we have this technology. So I don't think the technology is used. And that then opens up this gap where, yes, there's a lack of transparency. There's also a lack of accountability. So will banking institutions take accountability for and responsibility for some of the practices that they're put out? So if today, give an example, a financial institution is compromised, are they able to actually take responsibility and accountability for what happens then moving forward? And do we have the right practices in place to actually touch on that and sort of mitigate those issues? So I think we do have a lot that we have access to and capabilities. I think it's, they say we have more power at our fingertips than entire generations that came before us. The question is what we will do with it.
Now, briefly before I cross over to my other guest, let us introduce Dimad Shah. He is the CEO of Craft Silicon, and he has been with us via Zoom. Dimad, you can hear us? Yeah, he's waving. Gentlemen, be kind and wave back.
I think it's,
There you go. I presume you've been following our conversation. Let's hear your 2 cents this far. To my other guest, let us introduce Dimad Shah.
I've actually been having a lot of audio issues on and off, but I have been...
Dimad, you can hear me?
Pretty much.
Yeah, he's waving. Gentlemen, be kind and wave back. Dimad, if you're there with us, I was asking if you've been following the conversation and what your 2 cents are this far. However, as we try to reach back out to him, he's with us. Okay, Dimad, go ahead. Dimad, I was asking if you've been following the conversation this far. What are your 2 cents? Well, as our tech team tries to work the magic of technology, Dr. Ari, let me come to you. Where do we go from here?
Where do we go from here? The world is an interesting place now. Before I walked in, I was just telling one of my colleagues that the world has changed forever, be it in banking, be it in education, wherever it is, the world has changed. And I think this is an opportunity for us to sit back and reevaluate. Where do we go as the banking sector now that digital is no longer an option? I mean, it is the business. We must go to it. Fintech is no longer something we drum every other time. It is the business that we must do. And there is something Sam mentioned that I really think we need to think about, which is structured finance. We have, I think, some of the best laws in structured finance on the continent. But unfortunately, we don't do any single structured finance. South Africa is at 40% of the financial and banking sector in structured finance. We need that for us to be able to customize solutions to reach the low-end Mwananchi, like we call Wanjiko in this country.
For my viewer who might not understand what structured finance is, very briefly.
I'll give an example. So let's say I am a trader or a farmer. So I come to you and buy fertilizer, which I'm going to use for my farm. So the bank has funded me. I have gone and bought from my supplier. I have 1 acre piece of land. I use some fertilizer, then the balance remains. Where do I take what remains? Nowhere. So either it goes to waste or something. What if we got a product that tells the supplier, if you remain with, say, half a sack of this fertilizer, you have a buyback guarantee. And on the back of that, the supplier has a bank or a financier who is telling them, okay, if you buy back this fertilizer, then you have my guarantee. That's just an example of structured finance. You can do quite a lot of it, and there are real practical problems we face in this country. Mm-hmm. Yeah.
Okay, Dimat, I presume you're with us now?
Yes, now I can hear you.
Okay, so this far, if you've been following your conversation, I'd just like to pick up your brain. What are your 2 cents?
I have, unfortunately, I have not been able to follow the conversation because of the audio issues. Mm-hmm. But let me go ahead and add my 2 cents into the technology side of it. So fintechs, especially with the topic of responsible banking, fintech actually can help in a big way. It can, earlier, I heard some of our colleagues bring up the trust, delivery of services, stability, availability, and access to money anywhere, anytime. This is where we're making a huge progress in terms of making virtual banking possible, making virtual lending possible, customers being able to borrow money without ever stepping into the bank by applying directly from the mobile platforms. Whether they have smartphones or even the traditional phones. So these are the areas where we feel that we bring a lot of value to the banking sector.
Okay, so what would you say is the role of technology from where you see it in responsible banking?
The role of the banker is really to make, certainly I've been hearing on and off this balance between credit risk versus lending. I also heard a small bit about the Sme Lending. And I think this is where fintechs can come in and provide non-traditional ways of rating a customer for their creditworthiness. For instance, some of our products allow our partners, which are the banks, to evaluate the transactions a customer does based on their mobile banking records, mobile money spending, the transactions that flow, the type of bills that they're paying. And we assimilate all of this information into coming up with a credible credit score, especially when the credit scores are not available, during this crisis time where the credit reporting has somewhat been restricted. There has to be a different way of evaluating in order to make lending more credible rather than taking a shot in the dark. And I think fintechs like Silicon make a huge progress in these areas.
I'll come to you briefly in a minute as we almost wind up. But Mr. Mkoko, I'd like to find out from you, where do we go from here in terms of responsible banking? But because you're in the credit reference bureau space and there's data, how can banks begin adopting this data and using it to foster responsible banking?
Yes, that is the elephant in the room and in the banking industry. When are we going to see data-driven decisions happening? When are we going to see analytics getting into the decision-making process? I think that if you look at these things from a central bank point of view, central bank has tried to push as much as possible for banks to move into risk-based pricing, banks to start sharing. I think they're building a platform where banks can get data real time in terms of what they submit and what they get from the central bank. Banks can now get sharing data with credit reference bureaus at end of day, which is almost going to real time, which means that if a customer gets 2 credit facilities in one day, the bank should be able to see that the customer's profile in real-time basis. What then this means is that more Kenyans are now able to access credit, and because more Kenyans are able to access credit, the opportunity for banks to move to risk-based price is now here. And once they move to risk-based pricing, then it will become easier for customers to start engaging banks to negotiate rates that are appropriate to their risk profile. I think the day that happens in this country, that will be a real milestone, that a customer is aware that I am being overcharged here when my credit, my risk profile is low. And other customers should know that if I do not take care of my credit performance, I am going to access credit at a very high rate. And that's the direction that the industry should now move.
So, Met, your parting shots with regards to probably technology in the responsible banking space?
I think we're at an inflection point if you look at what's going on in the world today around technology. So I think, you know, we do have access to these technologies. They have been created by either startups, by either companies. So we do have access to the technology. I think it's time that we now start embracing those technologies, but also put in place practices that then allow us to be, you know, to leverage them responsibly. Because, you know, as I always say, never underestimate human ingenuity.
Never underestimate human ingenuity. Shah, I want to cross over to you. When he says we need to adopt these types of technologies, what types of technologies precisely are we talking about? I was asking, Samet has rightfully said that moving forward, banks must adopt technology, and that's something that has to be done. It's 2020, but what different types of technologies or what types of technical structures do they need to put in place moving forward? Come back to you in a few. Finally, Daktari, throughout this conversation, we've said, let's build trust, let's build trust, let's build trust. How can that trust be built between the banker and the customer?
What crosses my mind is the very lengthy forms that Sme talked about that banks used to give to you. And so someone gives you and then they tell you, sign here. So you don't know. So I think there is a lot of customer and consumer education that needs to go into this. And so the consumer knows this is my obligation and this is my right. Then the banker obviously already is, we are taking them to be at a more advantaged place than the consumer. And not to underestimate the whole question of data-driven decision making. So even as you walk to me, I already know what kind of consumer I'm going to meet as a banker.
Okay.
That way, then the trust will be built.
Sme Mkoko, GMD, Metropol Corporation Limited, Ferdinand Otieno, Strathmore University, and Somet, Microsoft. Thank you for making time. And thank you for having this conversation. And you too can always be a part of this conversation. We've been talking about responsible banking. What are your 2 cents? Do you think your bank is responsible towards you? Do you think they are making data-driven decisions when they are giving you loans, whether they are long-term loans or short-term loans, as Mr. Mkoko said? Do you think they're using data and they're using your credit score to decipher what interest rates they're going to charge you? Is just a blanket cover for everybody? What do you as the end consumer think should be done to ensure that banking is fair, business-wise to the banker, and business-wise equally to you as the end consumer? Talk to us. The hashtag to use is Best Banks in Kenya 2020. This is Think Business Banking Awards 2020, the virtual and coming to you live from Metropol TV. The handle to use is at Metropol TV KE. Atundi Roganga. We shall be sampling some of that feedback. When we come back, we take a short breather, but do not go anywhere because the big awards are coming and you do not want to miss it.
How do you measure success? There are indicators every business uses: revenue, time to market, customer satisfaction. But it's not enough to just measure success. You need to drive it by leveraging your most powerful predictor, people's day-to-day actions. The behaviors of people and teams, how they communicate, collaborate, navigate processes, how they network, innovate, and build customer and partner relationships. All these actions directly impact your business outcomes. Because what separates high-performing organizations from the rest is the way people work. If you could quantify how everyday work impacts your business, then you could better predict and control your outcomes. The good news is you already have the data you need to identify and then replicate the patterns that lead to success. By harnessing these critical insights, you can understand and then influence how work happens. With this knowledge, you can engage your workforce and empower people to move more swiftly, foster innovation, feel happier, and create more value for your customers. This is what will separate you from the pack. A powerful and continuous cycle of improvement that unlocks new potential and predictive capabilities for breakthrough business performance. This is workplace intelligence.